Welcome to the Money Answer Show with host Jordan Goodman. Whether you are starting out, deep into your retirement, or somewhere in between, the Money Answer Show has the know-how to help you. Now here's your host, Jordan Goodman.
Welcome to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Bob Carlson. He's the editor of the monthly newsletter and website called Retirement Watch. He's also written several books, including one called The New Rules of Retirement, another one called Personal Finance After 50 for Dummies. Welcome to the Money Answer Show, Bob.
Thank you. Good to be here.
Just give us a little bit of your background. You've done these books, you do the newsletter, but just give us a little bit of your background in leading into doing these things.
You know, I was trained as an attorney and an accountant, and after a while I decided I was specializing in tax, and I decided I wanted to do something broader than tax. So I looked into personal finance, and I started doing and I was actually doing a newsletter on taxes, and I got a lot of questions about retirement issues. And I looked around, and there was nothing for people to refer people to. So I started this newsletter, Retirement Watch, almost 30 years ago, and we've had a good response to it. We try to cover all the different aspects of retirement finances, and try to give an independent, objective look at things. We're not selling anything. We're not affiliated with a mutual fund or a brokerage firm. So it's been well received, and we hope to keep it going.
Very good. Let's kind of take a broad look at retirement first, because we're going to get to all these issues specifically. Are most Americans, we have all these baby boomers now getting to retirement age, are most people arriving at retirement in good shape or not good shape as far as the financial planning they've done to have a decent retirement?
Well, most are in pretty good shape. There's a significant minority that's not in good shape. And then another issue is there's a group that's in good shape right now, but if there's a tumble in the markets, or they have some unexpected expense or other event in their retirement, well, then they're going to be kind of drifting to being in bad shape. So there's a nice minority that's in really good shape. There's a group in the middle that's in good shape, but outside events could knock them off track. And then there's a substantial minority that needs some help or needs to make some changes.
Now, there was this recent Secure Act that was passed by Congress. Was that a significant act, and what are some of the things people should know about it that'll help them in their retirement?
Yeah, it's going to make a big difference. Mostly good, but a few bad things in there. Secure is an acronym for setting every community up for retirement enhancement. And the main part of the law is to make it easier and less expensive for small and mid-sized businesses to establish retirement plans. It also allows businesses with retirement plans to automatically enroll people easier and increase their automatic contributions to the plan. And for people nearing retirement, it knocks down a substantial hurdle to offering annuities to people as they're approaching retirement, so it can become easier to convert that 401k plan into an old-fashioned pension plan by buying an annuity that's going to give you regular payments for life. It also makes some small changes that are going to be helpful. Going forward, you can make a contribution to a traditional IRA at any age. Before, you couldn't make contributions after age 70 and a half. Another small change is it defers required minimum distributions to age 72 instead of age 70 and a half. So it lets you leave that money in the plan a little longer, and also makes it a little easier to figure out when you have to take those distributions. Now, one negative part of the law, these other things, they cost tax revenue. So Congress had to find a way to make up that tax revenue. So it ended what we call the stretch IRA. Stretch IRA is when your child or grandchild inherits your IRA as a beneficiary. Previously, they could allow that tax-deferred compounding to continue working for a long time. They only had to take distributions over their life expectancy, so they could take a relatively small amount out each year, and if it was invested well, the IRA would actually continue to grow in value over the years, and they could use it for some big ticket item in the future, whether it's buying a house, paying for their children's education, or even financing their own retirement. But that all was changed in the Secure Act. Now you have to, if you inherit an IRA, in most cases you have to empty it and pay taxes on it within 10 years. And this applies to a Roth IRA as well. So you have to empty that out and begin putting it into taxable investments after those 10 years or sometime within that 10-year time frame. So that's been kind of a negative aspect of it that's affected the estate planning of a lot of people who plan to have their IRAs help out their children and grandchildren over an extended period of time. But those are the highlights of the Secure Act.
Do you think, in fact, medium and small-sized businesses will start offering retirement plans? I mean, they still need to afford it. This is going to make it administratively easier, but do you think that will become more common in small businesses?
It's going to make it administratively easier and reduce the cost. I think the real issue are the big financial services firms going to put together packages of retirement plans that comply with the Secure Act and that really do make it easier and cheaper for these small and mid-sized businesses to establish their plans. I don't think too many of these small and mid-sized businesses are now going to go out and set up a plan on their own. I think it's going to be up to the financial service firms as well as the associations that these small businesses belong to kind of get together and put together some kind of package that's attractive for these businesses that have not put in a plan to date, make it attractive for them to finally offer some kind of a tax-deferred saving plan to their employees.
Do you think that these small businesses would match employee contributions as is common today in big companies?
Yeah, that's going to be a big issue. The small businesses I know, they're really hesitant to do a match because it's not something they can adjust easily going forward once they've established that match in their plan. They kind of have to do it each year no matter how their business's cash flow is going. So I think a small business is much less likely to match the way a larger business does. And I think the ones that do, they're going to match at a much lower level, put that maximum match for the year, a much smaller amount than a large business will.
And then you talked about the possibility of annuitization of a lump sum of a 401k. Is that in general a good idea for people to do? I mean, we have very low interest rates today. What kind of interest rate would people lock into? And is that a good idea to lock in for the rest of your life?
Yeah, that's been the big trade-off is when they do surveys of people who are in or near retirement, they say the one thing they'd really like is guaranteed lifetime income. And that would be an annuity for most people. But when you look at sales of annuities, they're increasing somewhat, but they're not increasing greatly. And the low interest rate, the amount of income you can get for each dollar you put into the plan is not attractive to a lot of people. And I think that's been one of the major impediments right now. You would expect with the baby boomers, more and more of them retiring and growing in numbers, that there'd be much greater sales of annuities so people could get that guaranteed lifetime income. But they look at interest rates and what kind of return they're getting from that annuity. And many of them are thinking, well, I'll wait until interest rates get back to some normal level rather than locking in this lower level for the rest of my life.
And in fact, it's going the other way right now. We have interest rates plunging because of the coronavirus. The long-term 10-year Treasury is down to almost 1% and dragging all the other rates down with it. That's probably one of the biggest questions you have from your listeners and your viewers. What do you tell people who need to produce income from their capital with interest rates as low as they are today?
Yeah, they really need to look outside your traditional retirement income investments. You need to look outside money market funds and CDs and government bonds. Look at other investments such as preferred stock, closed-end funds, master limited partnerships, and some other things. Now, those have more risk than these traditional retirement investments. So you have to buy them when they're at low levels, when they're down for a period of time, and then monitor them and decide, at some point, you're going to reduce one of these investments because another one is looking more attractive. So these are not, I think, buy and hold investments, but they do offer substantially higher yields and income than your traditional retirement investments. And as long as you pay attention to them and move in and out of them, always make sure you have a margin of safety in your portfolio, then you can get a decent yield with a reasonable amount of safety.
Now, some would say that people have done that and therefore pushed up the price of what I would call bond surrogates, like utilities, REITs, MLPs, preferreds, to unreasonably high valuations, and therefore they're risky. Would you agree with that?
That's happened in some cases, particularly with some of these closed-end funds where they used to sell at discounts to net asset value. They're now selling in a lot of cases at premiums, so you're actually paying more for the assets than they're worth in the market. The other investments, they go up and down. You know, people see headlines where they say high-yield bonds are hot, so a bunch of money flows into high-yield bonds, pushes up their value too high, and then they start to fall. But other investments are neglected in that time. So that's why I say these are not investments you really want to buy and hold. They're ones you want to look around in the market, buy the ones that are currently out of favor, and then monitor them, sell them when they start to make headlines, when they got big gains in them, starting to attract a lot of investment capital. So it's not buy and hold investments. There is some risk in it.
What would be an example of something that you think is currently out of favor and still attractive to get a higher than normal yield?
Well, right now, excuse me, preferred stocks are still pretty good investments. You can get a good yield. Excuse me, sorry about that. I would look at preferred stocks. I'd be very hesitant to go into high yield bonds. REITs have been pretty good. They come down a little bit in this coronavirus scare, but before that, they were good values. We're starting to go up in value at pretty good yields. So right now, I'd focus on those, plus emerging market bonds have also been pretty good. They had a bear market from about 2016 through most of 2019. They've started to turn around. So you get a much higher yield than U.S. Treasury bonds, but they've been pretty stable, pretty safe. So the emerging market bonds, preferred stocks, and the REITs, I think, are the top three income investments I'd look at right now.
Very good. We're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Bob Carlson. He's the editor of the monthly newsletter and website Retirement Watch. He's also written a book called The New Rules of Retirement and Personal Finance After 50 for Dummies. You can find out more about him at his website, retirementwatch.com. We'll be back after this.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman. My guest this hour is Bob Carlson. He's the editor of the monthly newsletter Retirement Watch. You can find out more about him at retirementwatch.com. Bob, we talked a little bit about ways to earn high income in this environment. One of the things we talked about was preferreds. So is there a mutual fund or ETF that would be something you'd recommend in the preferred area?
Yeah, there are actually two funds I like. If you want to go with a traditional mutual fund that doesn't use leverage, doesn't trade on a stock exchange, I like a fund called Cohen and Steers Preferred Securities and Income. The ticker for that is CPACX. It buys a wide range of preferred stocks. It doesn't try to follow an index. It buys the preferred globally. So it gives you a better chance at both safety and higher income. It eliminates some of the junky stocks that are in some of the preferred indexes. So I like that one.
What kind of yield does that pay, roughly?
Let's say that again.
What kind of yield does that pay, roughly?
Right now it's paying between 4 and 5%.
Okay. And what is the other one?
Then I like, if you want to take a little more risk, get a little higher yield, I like the Cohen and Steers Limited Duration Preferred. It's a closed-end fund. The ticker is LDP. It's paying a much higher yield now. It's 7 or 8%, but it uses leverage, so it can be a little more volatile if markets go down. But because it uses limited duration preferreds, it's less likely to get hurt as much by interest rate increases. And like the other fund, it invests globally, doesn't try to follow an index. So they can eliminate some of the junkier preferred stocks that are in the indexes. So I like both of those, just depending on how much risk you want to take in return for getting a higher yield.
Great. And then real estate investment trusts, which buy institutional real estate, what would be one or two either individual REITs or REIT funds or ETFs that you would like?
Well, I like also from Cohen and Steers. It's called Cohen and Steers Realty Shares. It's a traditional open-end mutual fund. Ticker is CSRSX. It's been around. It's what really was the first REIT-only fund. Firms really specialized in REITs. It's got an outstanding long-term record. It's usually in the top 10% of REIT funds over any kind of period you want to look at. So that's always a good way to go. It focuses on a relatively small number of REITs. So they look into these REITs in great depth, and they buy only the ones that management is pretty confident are in good shape and are going to do well. And then another interesting fund is a closed-end fund, and this has a combination of REITs and preferred stocks in it. It's called Cohen and Steers REIT and Preferred Income. The ticker is RNP, and it's about half REITs, half preferred stocks. It uses leverage as well. Yield is around 6%, and the preferreds give it a good income, and the REITs give it a good shot at capital gains. It's another fund that it's done pretty well over the long term and also done pretty well recently. So that's one I like, where you get both of these asset classes in it.
What would be another closed-end fund that's not preferreds or REITs that you would like for income these days?
Okay. There are some. There's one I like. It's called Cohen and Steers Infrastructure. This buys a range of infrastructure companies anywhere around the globe. It could be utilities, toll roads, airports, freight lines, pretty much anything. So it's pretty well diversified, both globally and as well as in industries. The yield on it's usually around 8%. It's had a really good return over the last year. It's come down a bit in this correction due to the coronavirus, so this could be a good opportunity to get back in it or to add it for the first time. But it's had a very good long-term record, and infrastructure companies tend to be some of the more stable companies out there in the markets, and they mostly pay good yields. So I think it's a pretty good income opportunity for an investor.
And what's the symbol on that one?
That one is UTF.
Okay, very good. Okay, terrific. Those are some really great ideas. So now on the other side of income for individuals is Social Security. Are you feeling pretty sanguine that Social Security is going to be okay, or do you think major changes need to be made in it to keep it solvent?
Well, it's going to depend on your age. The annual report from the Social Security trustees says their latest estimate is that in 2034, the trust fund is going to run out. Now, looking longer term, every year we pay taxes. Anyone who's working pays Social Security taxes or self-employment taxes that go to the Social Security system. And those are going to be high enough going forward indefinitely to pay about 80% of the benefits that are promised, even after that trust fund runs out in 2034. So it's really that 20% gap that's going to need to be closed at some point. And when Congress finally gets around to acting on that, I don't think they're going to affect people who are already retired or close to retirement. But younger people are going to look at a combination of higher taxes and lower benefits. So if you're currently in that retirement red zone, as they call it, you can probably count on receiving Social Security just as they're promised under current law. If you're younger, if you're, say, 10 years or more from retirement, then you're probably going to look at some changes going forward. Also, if you're in or near retirement now and you're very high income, Congress might decide to means test the program to close some of that gap, and so either reduce the benefits or increase the taxes on higher income people who are already retired and receiving the benefits. But I think most of the burden on closing that gap is going to be from people who are 10 years or more from retirement right now.
Well, we've been talking about this for ages, and Congress has done nothing. What's going to change to give Congress people the courage to go and make those changes?
Well, Congress's normal pattern is to wait until the last minute before they actually act, and that's what they've been doing so far. You might recall President George W. Bush tried to get some kind of reform in place during his second term, and nobody wanted to go along with that. And it's really going to be a question of when the voters are going to start telling their congressmen and senators that they want them to start working on this problem and not wait till the last minute, because the longer ahead of time that they put together a solution, the lower the cost is going to be to each individual. But if they wait until the last minute, then the changes are going to be more drastic, and the cost of each individual is going to be higher than it otherwise would have been.
Since you say you think Congress waits till the last minute, let's assume that that's correct. What would that look like if they waited to 2033 or something like that to make a major change? Would the tax increases be enormous and the benefit cuts be enormous?
Well, I don't think they're going to be enormous. It really depends where they do the cutoff on, who's going to be grandfathered and keep the old benefits unchanged, and who's going to, have to bite the bullet basically and pay for this gap. I think they're more likely to lean on higher taxes in some way. A most likely change, right now there's no Social Security taxes when your income is above a certain limit, which I think right now is around $133,000 a year. They might just remove that. A few years ago, they did that for Medicare. The Medicare tax used to have the same limit, but they removed that a few years back because the Medicare trust fund is in worse shape. And they might do the very same thing with Social Security and say people are going to owe the Social Security tax and self-employment tax each year, no matter how high their income is. So that's one group that's probably likely to have a severe change. I think for other groups, it's probably going to be phased in. The benefit changes will be phased in based on how old you are and when your target retirement date is.
Very good. We're going to take another break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Bob Carlson. He's the editor of the monthly newsletter Retirement Watch. There's also a website related to that. His latest book is called The New Rules of Retirement, and he also wrote one called Personal Finance After 50 for Dummies. You can find out more at his website, retirementwatch.com. We'll be back after this.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Bob Carlson, editor of the monthly newsletter Retirement Watch, which you can find out about at his website, retirementwatch.com. Welcome back to the show, Bob.
Thank you. Good to be here.
You mentioned briefly that the solvency of Medicare is in worse shape than Social Security. Tell us a little bit about the current situation with Medicare and what might happen to shore it up.
Yeah, that trust fund is scheduled to run out of money sooner than the Social Security trust fund. Like Social Security, there are taxes paid each year, and also the Medicare beneficiaries pay premiums each year. So it has two sources of income, but there really is no discussion of what Congress might do to fund the difference once the trust fund runs out. In the recent past, they've periodically tried to make some changes which usually involve them paying less money to doctors and hospitals, but each time they do that, what happens is that fewer doctors and hospitals participate in the plan, and they decline to take new Medicare patients. That's really up in the air. I haven't heard any really serious discussion about what might happen and what policy changes might occur once that trust fund runs dry.
And what year is it scheduled to run dry?
I forget exactly, but I think it's within 5 years or so.
So again, this is something that Congress should probably deal with at the last moment. What are the possibilities? Could they raise the taxes dramatically? Or, as you say, when they cut the expenditures, doctors and hospitals don't accept it. So it doesn't seem like they can cut expenses too much more. And demographically, the baby boomers keep going into the Medicare program. So what are the potential solutions?
Yeah, they could raise the taxes. They could also raise the premiums on the beneficiaries in the program. Or they could just decide to fund it from general tax revenue. They have no trouble with deficit spending, apparently. So that might be the way they go, is just decide to fund it each year from general tax revenue until they figure out some longer solution.
So Bernie Sanders is running around leading in the polls at the moment on the Democratic side, saying healthcare is a human right and everybody should have Medicare for all. Let's just for a moment say Bernie Sanders gets elected, has a Congress that will go along with him and implements Medicare for all. What would be the impact on Medicare of that?
Well, there's a lot of things people don't understand about Medicare. Medicare is set up so that the premiums have to fund about 20% of the program each year. So the rest of that comes from the taxes. So if we do the same thing for the general population, then really the government has to find a way to fund 80% of our national medical bill, which is going to be a lot of money. Also, individuals are going to have to pay that 20% in taxes, and they might be surprised at how high that turns out to be. In addition, if you give everyone medical insurance like that, you're probably going to increase the use of medical services. So we might, people in Medicare right now find it's very difficult to get an appointment with a doctor and to get other treatments scheduled. It's usually months in advance they have to make their appointments. So if we shift this plan to the general population, you're likely to see doctor and hospital shortages like there are in Canada and Great Britain, and people might be surprised at how long they have to wait to get their medical treatment and to see doctors.
So you decrease supply of health care and increase demand.
Correct.
Without having the price go up.
Right.
Doesn't sound like you're too big a plan on this plan.
No, I've seen how Medicare works just for the retirees. And, I don't think the people who are considering applying it to the general population have really thought through the details.
So for people getting into Medicare today, there are these Medigap policies and Medicare Advantage plans. Is that important for people? Because most people think Medicare is going to take care of pretty much everything.
Right. That's a classic mistake many people make as they're approaching retirement, is they just assume Medicare covers all their retirement health care needs. And that's not the case at all. There are significant gaps in Medicare that many people don't realize until they've had their first major medical expense after age 65. Medicare does not cover a number of types of services. It doesn't cover any dental, vision, doesn't cover the hearing aids. But most importantly, there's a 20% copayment on pretty much everything Medicare does cover. So you go to the doctor or the hospital, you're liable for 20% of the bill, no matter how big it goes. So if you don't have something other than Medicare, and you go in for something major like cancer treatment or a heart bypass, anything like that, a joint replacement, those typically cost tens of thousands of dollars, and then you're going to have to pay 20% of that no matter what the limit is. So that's why, in addition to Medicare, If you're going to go with original Medicare, you need a Medigap policy, also called a Medicare Supplement policy, and that will cover all or most of the gaps depending on which type of policy you get. Another alternative is, instead of going into original Medicare, go into a Medicare Advantage plan, which covers all or most of the gaps in Medicare and also offers additional services such as those vision and dental benefits. So, Medicare, while it's a great benefit to retirees, it's not the whole package for you. You do need to get one of these additional plans, either a Medicare supplement, and you also need a Part D prescription drug program, because a regular Medicare covers hardly any prescription drugs, and prescription drugs are the major medical expense of most retirees. So you need to have those things covered as well as what Medicare covers.
A lot of people think Medicare covers long-term care as well, things like going into a nursing home or having home health aides, something like that, which it doesn't. Do you think it's a good idea for people to get long-term care insurance?
Well, there are different types of long-term care insurance now. There are the traditional long-term care only policies, which have had a tough time since the financial crisis. A lot of the insurers have gone out of the business. The ones that remained in the business have substantially increased premiums and reduced the coverage. And the sales of those policies are now well below 100,000 policies a year. So it's still an open question of whether those insurers are going to be able to continue in that line of business indefinitely. An alternative now is what they call the hybrid or asset-based policies, where you buy either an annuity or a permanent life insurance policy, and it comes with some kind of long-term care rider or long-term care coverage, so that, for example, if you put in $100,000 to this policy, if you need long-term care at some point in the future, this policy will cover 2 or 3 times the amount you put in long-term care benefits. So if you put in $100,000, you might have long-term care benefits of $200,000 or $300,000, in some cases more. So that's a way you can go where your benefits are more clearly defined, and you have less doubt about premium increases in the future and what might happen to the insurance company. So either of those two are a way to go, but if you don't have enough assets to self-finance long-term care, you need some kind of insurance package.
Yeah. Now, some people say that a lot of the medical expense is in the final year of life, maybe most of it when you get down to it. And that's what's really exploding Medicare costs so much. Do you think something might be changed where if somebody who's terminal or in the ICU for months and spending hundreds of thousands of dollars, that they'll cut them off from spending all that money, which is in a certain way, not creating a productive life?
Yeah, that's actually what happens in a lot of the countries where there is a government-run medical system. They ration care, and your age and your health, to some extent, determines whether or not you're going to get treatment. In the U.S., in the Medicare system, if you're in original Medicare, you basically get to decide how much medical treatment you want, and if you can't make decisions, your family makes them for you. And often people opt for whatever options the doctors throw out there, if there's some hope that will extend life or make it or even cure the disease. If you're in a Medicare Advantage plan, they might put more limits on it. But really, that is a major expenditure in U.S. is the amount spent based on that last illness. And as the costs go up and as government gets more involved in medical care, it's also going to get involved in those medical decisions and put in some kind of guidelines and rationing.
Yeah, that certainly seems to be what's coming. Very good. All right, we're going to take another break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Bob Carlson, editor of the monthly newsletter Retirement Watch. He's also written a book called The New Rules of Retirement, and you can find out more at his website, which is retirementwatch.com. We'll be back after this.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Bob Carlson, the editor of the monthly newsletter Retirement Watch. You can find out more at his website, retirementwatch.com. Welcome back to the show, Bob.
Thank you. Good to be here.
So we talked about Social Security. We talked about Medicare. There are some scams aimed at Social Security benefits. Just tell us what people should watch out for there.
Yeah, in the old days, crooks used to go down the street and grab mail out of mailboxes, and then they'd go home and sort through it looking for Social Security checks, and they'd try to cash them. And that ended when Social Security started going to electronic benefit deposits. But a few years ago, it allowed you to create what you call My Social Security account on the Social Security website. And that's been really good for people. They can do a lot through those accounts, and they're good to have. But what happens sometimes now, and it's getting more and more common, is these crooks will use these My Social Security accounts. What you have to realize is you've probably had your information stolen at some point because various businesses and organizations have it, and many of those have had data breaches, and your information is probably for sale on the dark web somewhere. So what people do is they buy this personal information about people, and then they try to tap into My Social Security accounts. If you've already opened one of these accounts, they try to go in there, figure out your ID and password, and then simply change the bank where the checks are being electronically deposited from your bank to their bank. Another thing they do with someone who has not opened a Social Security account, particularly if they're age 62 or older and are not receiving benefits yet, is they'll open up an account for these people in their names, but with the crook's bank account number instead of the individual's bank account number, and they'll begin your Social Security benefits. You might not have wanted to begin them yet. You want to wait until the benefit amount is higher. But if you're age 62 or over, they can just go in and tell Social Security to start paying the benefits and then have them deposited in the crook's accounts. So that's what's happening is some of the thieves are using these accounts to take people's benefits, to have it transferred to the crook's bank's accounts instead of the Social Security beneficiaries' accounts. And the way you protect yourself from this is open up one of these accounts, a My Social Security account, and then check it regularly. It'll tell you if there's been any activity involving your Social Security number in your account. It'll tell you if someone's tried to change the bank account where benefits are being deposited or applied for benefits in your name when you did not apply for benefits. So the best way to protect yourself now from these scams is to open up a My Social Security account and then monitor it every month or two to make sure there's no unauthorized action going on in the account.
I assume Social Security is aware of all this. What are they doing to stop these kind of things?
Well, they have a big notice on the homepage of their website to warn you about it, for one thing. And then they use the usual data protection things that organizations do. They try to look at the activity in accounts and monitor it. So they are taking steps, and they are warning people about it. But really, it's up to you to make sure that you open that account and you monitor it and you notify Social Security right away if some suspicious activity is going on.
Wouldn't it be easy to find the crook if you just see who owns the bank account where they've transferred the money to?
Well, normally these are overseas crooks, and the initial bank account is just a temporary account. So once it gets in their account, they move it to another account. The first account was opened probably in a fake name and things of that nature. So it's difficult for them to really locate those crooks because they put in this kind of chain of protection, and also because they're overseas somewhere, usually in a country where law enforcement is not that strong, and they don't consider stealing Americans' Social Security benefits a high priority item.
I see. What is the other big fraud you're seeing affecting the elderly these days?
Well, what happens, one big thing is is basically what they call affinity fraud, where someone you know or some organization you know is being used as a way to get you to give up your money, whether it's an investment through a friend or through someone who says he's working with an organization you're affiliated with, or something of that nature. But something where people can use something you think you know, think you're comfortable with, try to let you drop your guard, and then they'll use that to kind of get you to buy items that don't really exist, or to invest in things that aren't really investments, so they can just take your money and then disappear. What we find is that as people get older, they become more trusting. They're less suspicious of people. And so when someone makes a reasonable argument, they want to believe them. They don't want to be suspicious, and that they're less likely, to really look at all the details of it and to try to think what's wrong with it. They're more likely to believe what someone tells them and to give them money if it seems like a good product or a good investment.
In about 2 minutes we have left, why don't you kind of sum up the difference it would make in people's lives and the kind of retirement they have if they take the kind of advice we've given here, as opposed to not taking that advice?
Yeah, it can, there's not a big difference between a successful retirement and an unsuccessful retirement. It's really a few marginal decisions, making sure you take Social Security at the right time, making sure you don't have those big unexpected medical expenses, so you close those gaps in Medicare early in retirement and continue that throughout retirement. And, be on the alert for the usual traps that affect people, whether it's the bad investments, the scams, things of that nature. There are just a few things like that that really are the keys to a good retirement that's secure, and to tumbling into an insecure position just because you miss some of these key steps.
Very good. We've given some great advice on some ways to earn some higher yields and getting Medigap policies and taking care of long-term care, and we took care of Medicare, and we took care of Social Security. So I think we gave people a lot of advice that can hopefully be helpful. Thanks so much for being a guest on the Money Answer Show, Bob.
Thank you. I enjoyed it.
Thanks again. We'll be back next week with another edition of the Money Answer Show. Goodbye for now.
Thank you for joining Jordan Goodman and the Money Answer Show. If you have a question for Jordan, please visit his website at www.moneyanswers.com. And be sure to tune in every Monday at 12 p.m. Pacific Standard Time right here on Voice America Business. See you next week.